It's 2 a.m. You're scrolling through crypto Twitter, halfway through your third energy drink, watching some teenager with a laser eyes profile picture brag about turning $500 into $50,000 on a coin called something ridiculous. Meanwhile, Bitcoin is sitting at $74,000. You do the math. With your savings, you could afford maybe 0.006 Bitcoin. That number feels small. It feels like failure. So you start looking at cheaper coins, tokens you can own by the thousands or millions, something that makes you feel early, something that makes you feel like a whale. That's the moment most people go wrong. Because the goal isn't one full Bitcoin anymore. That era is gone. But zero point 0.1 Bitcoin? That's the real psychological and financial threshold. Not because it guarantees wealth, but because of what it does to your behavior, your time horizon, and your mindset the moment you cross it. The unit bias trap. There's a psychological phenomenon called unit bias. It's the reason you'd rather own 10,000 units of something worthless than 0.1 of something valuable. Your brain sees Bitcoin at $74,000 and immediately calculates how little you can buy. 0.006 feels incomplete, insignificant, embarrassing. But if you take that same money and buy 1 million meme tokens priced at fractions of a cent, suddenly you own a lot. The number looks impressive, even though the value is identical. This isn't accidental, it's human wiring. Big quantities feel powerful, fractions feel small. That bias pushes millions of people toward low-quality coins that statistically underperform Bitcoin across full market cycles. Many never recover after bear markets. They fade into irrelevance, while Bitcoin, despite brutal volatility, has historically recovered from every major crash in its existence. Unit bias doesn't just cost money, it costs time, and time is harder to recover. The Alex pattern. Imagine someone with $5,000 saved when Bitcoin was trading around $43,000. That money could have bought roughly 0.116 Bitcoin. Instead, it gets split into several hyped altcoins because they have more upside. A few months later, hype cools, liquidity dries up, the portfolio collapses 70 to 90%. Meanwhile, Bitcoin rallies into the next cycle. Now the same person tries to accumulate 0.1 Bitcoin at a much higher price. What could have been achieved earlier now costs more capital and more discipline. This pattern repeats constantly, not because people are intelligent, but because psychology overrides math. The supply reality. Bitcoin's supply is capped at 21 million coins. Roughly 19 to 20 million have already been mined. The remaining coins will be issued gradually over the next century, with issuance cut in half roughly every 4 years. But that headline number is misleading. Several million Bitcoin are believed to be permanently lost due to forgotten keys, destroyed hard drives, and inaccessible wallets. That reduces effective circulating supply significantly. Now, consider global population. When you divide total accessible Bitcoin by billions of people, the theoretical average share per human is a tiny fraction. Owning 0.1 Bitcoin represents a multiple of that average. Whether or not Bitcoin ultimately succeeds, scarcity is embedded into its structure. That scarcity shapes its long-term narrative. Institutional accumulation. Over recent years, institutional products like Bitcoin ETFs have accumulated substantial holdings. Large asset managers and corporations now control meaningful percentages of total supply. When institutions buy and hold long-term, supply becomes less liquid. That doesn't guarantee price increases, but it does shift market dynamics. The average retail investor competing against institutions is no longer in a purely grassroots market. The game matured. Too late to get rich? It's important to be realistic. The era of turning $1,000 into generational wealth through Bitcoin alone has likely passed. Early adopters captured the extreme asymmetry. Buying at $70,000 is not the same as buying at $100. The upside profile is different, but there's a difference between getting rich and preserving purchasing power. In an environment of persistent inflation, monetary debasement, and expanding monetary supply, some investors view Bitcoin as a hedge against long-term erosion. Owning 0.1 Bitcoin isn't about overnight wealth, it's about positioning. What 0.1 Bitcoin represents? At $74,000 per coin, 0.1 Bitcoin costs $7,400. That's significant money for most people, but it's not unreachable through disciplined accumulation. If Bitcoin eventually trades at $250,000, 0.1 becomes $25,000. At $500,000, it becomes $50,000. These are speculative projections, not guarantees, but they illustrate asymmetric potential. Even if those targets are never reached, the act of accumulating changes behavior, and that behavioral shift is arguably more important than the price. The behavioral shift. Once you own meaningful exposure, your relationship with money evolves. You begin thinking in opportunity cost. A $200 impulse purchase becomes a fraction of Bitcoin you could have added. You start thinking long-term. You begin tracking inflation, monetary policy, macro trends. You develop what economists call lower time preference, valuing future stability over immediate consumption. The act of consistently accumulating an asset over months or years builds discipline. That's the real threshold, not the price, the mindset. The discipline path. For most people, accumulating 0.1 Bitcoin doesn't happen in one transaction. It happens through dollar-cost averaging, small, automatic purchases weekly or bi-weekly. At first, you check the price constantly. Every dip feels like regret. Every rally feels like validation. Over time, if you remain consistent, the daily swings matter less. You stop reacting. You start executing. That habit can extend beyond crypto into savings, investing, and spending patterns. The volatility test. Here's the uncomfortable part. Bitcoin can drop 30 to 50% in months. It has done so repeatedly. If you accumulate 0.1 Bitcoin at a high point and the price halves, watching thousands in value disappear is psychologically painful. If you cannot tolerate that volatility without panic selling, you shouldn't allocate heavily to it. This is not a savings account. It's a speculative, high-volatility asset. The people who historically benefited most were those who held through extreme downturns. That's easier said than done. The correlation reality. Despite narratives framing Bitcoin as digital gold, in recent years it has often behaved like a high-beta technology stock. When growth equities rally, Bitcoin rallies more. When tech sells off, Bitcoin frequently sells off harder. Until that correlation meaningfully changes, it should be treated as a volatile risk asset, not a stable hedge. What actually changes? Owning 0.1 Bitcoin does not automatically create wealth. It does not eliminate risk. It does not guarantee future gains. What it changes is perspective. You begin thinking in scarce digital units instead of fiat balances. You evaluate spending differently. You develop patience. Whether Bitcoin ultimately fulfills its most ambitious projections or not, that shift in time horizon and discipline can influence your broader financial life. The real question isn't whether Bitcoin will go up next month. The real question is whether you understand your own psychology well enough to hold a volatile asset responsibly. Because most people won't, and that, more than any price target, is what makes thresholds meaningful. Like, subscribe, and turn on the bell icon.